Good morning, podcast world. Hey, this is Angie. I'm with Producers XL, and you are now joining the Producers XL Persiflage, which is my monthly podcast. And not gonna lie, I changed directions this morning. I had something totally different planned for our podcast in the month of February, the love month, if you will, for February and Valentine's Day. And here we are wrapping it up. Hard to believe we've almost completed the second month of the year for 2026. No kidding, time flies. And yesterday I did a podcast, or no, I'm sorry, I did a webinar with National Guardian Life with regards to their newest launch of their new product called Honest LTC. And it went so well that I actually wanted to repeat this and give you my take, my highlights, kind of some commentary around that webinar. So, National Guardian Life, a traditional long term care company, has launched a new long term care, standalone long term care product, right? So, no death benefit tied to it, called Honest LTC. I have to tell you, I mean, I liked Essential LTC, but Honest LTC, it kind of blew me away. I mean, National Guardian Life went to the garage, and what they pulled out of that garage with Honest LTC is really where the industry is kind of sitting in the way of traditional long-term care. So through our agency, there's three traditional long-term care companies that you have out there. You've got Mutual of Omaha, National Guardian Life or NGL, and then you have Thrivent. And I wanted to give a little bit of a spotlight to the new launch of Honest LTC from NGL and let you know that on February 13th, so just about, it'll be 2 weeks at the end of this week that it launched out in 34 states. So roughly the compact states is where it launched, with the exception of a couple. And what they've done is given a 2 week transition. So anybody that is in underwriting right now, if they want to transition over to the Honest LTC, they sure can. Really, the only reason that you would look at Essential LTC currently, if Honest is launching in your state, would be because you want a lifetime benefit and you want the completely guaranteed 10 pay. So with the transition rules, right? Anybody written, and this was interesting to me, anybody that was written under the Essential LTC product clear back to May of last year can convert over a 60-day offer to convert over to the Honest LTC with no underwriting. Now you're going to fill out a new app. You're going to answer the health questions as if they're applying for Honest LTC, but they're not going to be underwritten. And then, of course, it's going to move over at their actual age. So you fill out an application. Those apps need to be in-house of those in April. So those were a lot of dates I threw out at you, but they've given you a lot of leeway for those people that might be pending and or bought the Essential LTC. Some of the things that I want to highlight from Honest LTC, some of the changes that they've made. So, of course, you still have the built-in joint waiver of premium. That's fantastic, right? Because with National Guardian Life's traditional long-term care product, it's one policy number covers two people. And we know that's their sweet spot, couples. Not necessarily married couples, but just couples, people in committed relationships applying together, similar age, if not the same age, because you know how they price it. They take the oldest person, rate them as a female, and that's how they're getting their joint pricing. So one policy number, two people covered. They each have their own separate buckets or pools of benefits, but you have joint waiver of premium. That's really solid because with the other carriers, you have to add that as an additional cost rider to get that joint waiver of premium, meaning when one goes on claim, premium stop for both. So that's really good. Shared benefit, still a fantastic feature on this. You're going to see them refer to it as a third pool. That just basically means, and if you could see me, I'm holding out my fist, right? It's his bucket of benefits, her bucket of benefits, our bucket of benefits. It's a third pool of benefits. So if they each bought 3 years, he has 3, she has 3, they have another 3 to share. So it can be 2 years, 3 years, 4 years, 5 years, 6 years, but they're going to share and they have to be identical benefits, right? So it's 5 and 5 and 5. Is it 15 for one person? No, it is. No, it is not. It's 10, the opportunity for 10, right? So that third benefit bucket or that third pool that they share, once they've depleted their own benefits, they can start sharing or using from that third bucket. They cannot deplete their spouse's benefit pool. So that always stays intact. So if they've bought 4 years, he has four, she has four, they have four, he's used his four, he can use the other four to where he would have eight, not depleting her four. So that's a good thing. That's a real good thing. Gives them some great leverage there. Under the Honest LTC, they're still going to offer the 10 pay. I'm going to get into that in a little bit. Like I mentioned, they've got benefit periods of 2, 3, 4, 5, and 6 years. What you did not hear me say was a lifetime benefit. Per my webinar yesterday with them, they did not sell a lot of unlimited lifetime benefits, so they've pulled that from their new launch of Honest LTC. It is not offering a lifetime benefit period, but you can go up to 6 years. And remember, if you're doing a couple and they share benefits, then you're actually giving one person the opportunity to have 12 if it's 6 and 6. Elimination period's the same, 90 days or 180 days. And they're still offering the optional rider that you can add with a charge, a very minimal charge, I will add, first day coverage for home health care. Very minimal charge. 10% is all it's going to cost to add that rider. It was costing under their other contract upwards of 25% for the first day coverage, which, when you start adding a bunch of optional riders to a traditional contract, it gets pricey. And so a lot of times we're selling traditional long-term care to fit a price point, to fit a budget. And so you start stacking on these riders, it gets expensive. But now you can actually go back to showing first day coverage for home health care because it's not a massive lift in premium to get that done. So some of the enhancements that they're adding, and this was only slide 3 of talking about the enhancements to the new product called Honest LTC. They could have stopped right after this one. I mean, there's some wonderful enhancements. Like I said, when they pulled this thing out of the garage, it really kind of answered what most of us are looking at when you're looking at a traditional, or should I say, stacks them up to the competition quite nicely. So they've maximized their stay-at-home benefit, their home health care. So, right, keep in mind, when you go into a facility, whether that's a nursing home or an assisted living, you're there every day, unless you're using bed reservation and you're in the hospital or you go to your daughter's house for Christmas or whatever. But it's usually you're there every day. So kind of by default, it becomes a monthly benefit. Now their home care, their stay-at-home feature is now a monthly benefit. So $1,500 up to $12,000 that you can get for your home care benefit. So it's now a monthly benefit. Like I said, stacks them a little bit more up to their competition. And we know in home care, when you're at home, that's kind of where the flexibility starts, right? You're probably not receiving home health care every day. But when someone comes in, maybe you need more than what your daily benefit was. This gives you that flexibility. The other thing that they've done is it's now a calendar day elimination. Now, what was really interesting to me, when we all think of calendar day eliminations, we think of, hey, if I go on claim and it's Wednesday and that's the first day I have paid benefits, they start counting Wednesday, Thursday, Friday, Saturday, Sunday, Monday, Tuesday, right? Calendar day. Every day counts. Their actual definition, if you look in their specimen contract and you read it, it actually states that 1 day of care equals or satisfies 7 days towards the elimination. So 1 equals 7. If you remember way back, that used to be a common thread we had with older long-term care policies. 1 day equals 7. And then everybody was like, oh, we're calendar day. It's just, once you've satisfied, we're just going to count every day. Kind of 6 one, half dozen to the other, if you will. But coming out of the garage again with Honest LTC with National Guardian Life, claiming they have a calendar day elimination. So that's good. Again, stacking up nicely to their competition. Then what they've done is they've actually allowed you the opportunity to drill into inflation. So you know under the NAIC guidelines, you have to be offered 5% compound inflation. That's why you always see 5% compound offered. Do people buy it? Not often, but it has to be offered and you have to actively reject by checking a box. And some of them actually require you to sign on a line that says, I'm rejecting the 5% compound. You can choose none, and most of them you can choose 3. Now they're giving you the flexibility under Honest LTC where you can actually opt for a 1, 2, 3, 4, or 5% compound inflation. That's fantastic. So again, there's a carrier out there right now that's offering percentage, even down to the 1/4% where you can dial up, dial down that inflation protection. This allows you under the partnership guidelines, not every state, right? I mean, some of them will let you go down to a 1% and still be eligible for the long-term care partnership, which is the dollar for dollar reduction of assets against Medicaid spend down. That allows you to kind of move that inflation, which is also great because if you're talking to your younger folks, 40s, 50s, again, the sweet spot for National Guardian's Life's long-term care contract, it allows you to maybe get them in on a contract with a lower inflation without driving that premium so high. So I love that. And it also kind of leverages the spirit of that partnership program in quite a few states. And then for some other, more client-friendly benefits, now if you're in a relationship, right, you have a discount for a partner. You've got a 5% partner discount. Again, I'm not going to say it's a married discount or a marital discount, but just a partner discount, living with someone in the same age demographic, right? So that's going to get you a 5% discount if you've got that, what we normally deemed a single female or a single male, when in fact they're married or in a relationship. However, that person doesn't want the insurance, can't qualify for the insurance. Whatever the case is, now you can at least offer a 5% discount to the partner that is applying for coverage. So that's good. Getting away from age nearest. I know that sometimes caused some heartburn when you were showing 3 carriers side by side and all of a sudden NGL had them a year older because they were nearest their next birthday. And then, of course, you have to explain to the client, hey, they run on nearest age, not actual age. For some folks, not a big deal. Easy to explain. You move on down the road. Others, stumbling block. Then they felt they were being charged more because they were rolling them forward. So now you are age last birthday. So actual age. And if you have a birthday, right, they'll save your birthday age. They'll go back and save it 30 days from your birthday. So that's fantastic. Again, puts them right in line with the rest of the competition. And the last thing on this slide where, NGL actually could have wrapped the whole thing up, they actually are now implementing the alternate plan of care, which is great. When you think about the natural fit for the client that National Guardian Life wants for their long-term care contracts, they want younger, they want longer benefit periods, they want the 5% inflation. I'm not saying they don't price well elsewhere. They do, and I'll talk to that. But those folks could easily, you got someone in their 40s and 50s, they're going to go 40, 30 years before they hit the statistical claim age, anywhere between, call it 75 and 85, depending on their health and such. But you're driving that benefit clear out there. Do all of us believe that the way we receive care today is the way we're going to receive it in 40 years from now? Absolutely not. No, it'll be interesting to see how I remember we used to do seminars and talk about how someday Rosie the robot from the Jetsons could be around. Well, guess what? She's here. We have robots. We have prompting and cueing from electronic, and heavens knows where AI is going to take us in the evolution of the long-term care spirit. So alternate plan of care, Very good. I like that the wording's in there. It allows for the flexibility and to receive care in the best interest of the policyholder, their need for care. Of course, everybody has to agree on it. Insurance company, doctors, all of that has to align. And if it seems reasonable, then they can pay benefits that way. So, wanted to let you know a couple of things. Obviously, National Guardian Life prices very well for couples. They're looking for similar age, younger folks. But I will tell you, in looking at their pricing, if you did, and of course, some of you are going to go, well, $4,500 a month in benefit, that's nothing. Well, keep in mind, in the Midwest, and what I mean by that is if you take the center section of the United States, we're very much still quoting $4,500 a month. Is it more than that? Absolutely. Do people fully insure long-term care risk? No, they do not. They co-insure the risk. Most people don't want to pay the premium for the higher benefits. So if I'm looking at, and this is all relative, if you look at a $4,500 a month joint policy, 3 years, 90-day elimination with shared care and a 3% compound, and you look at that across the board with the three traditional carriers that we have out there, you're going to see where the pricing for National Guardian Life between all of their ages, all up, and I'm going from age 50 to age 75, they're winning in the price comparison game just on that benefit structure. Now it's relative. You can take the benefit to 6,000 across the board. They're still going to win that pricing structure. This isn't necessarily about who's the cheapest. I never like to equate cheap to insurance because you've got to show the value and they've got to believe in what this is designed to do. However, pricing looks fantastic. That is the sweet spot for National Guardian Life. Even so, by adding that first day coverage for home health care rider on there, still all age brackets, still winning the pricing comparison between the three traditional carriers. Now, I think this is interesting. Most insurance companies would not jump out there and say, I'm going to show you a single female pricing, because single females buying long-term care insurance are expensive. They're more expensive than a single male. Why? Statistically, women live longer. Statistically, they're the ones that need the care. Their natural built-in spousal partner caregivers isn't there. And remember, as we age, our kids age. So kids are not really going to be the caregivers. So when you look at the pricing for a single female, same thing, taking that benefit to 6,000 a month, 3% compound, 3 years, single female, still ages 50 to 75, National Guardian Life's winning that pricing comparison. I'm not trying to necessarily win you over. I'm trying to ask you to give National Guardian Life another look. It's worth it. If you're selling traditional long-term care insurance, you've got to put them back in the mix. One other thing I wanted to make mention, obviously for single men, yes, pricing looks half of what it looks like for single females applying for coverage. I will tell you, however, when you get into the older issue ages, 70 and 75, they don't price the best. Goes to make sense. They don't want that upper age risk, right? So definitely worth looking at again. Wanted to make mention, they actually have now, National Guardian Life has a quick and easy online rate calculator. I've played with it. It's easy. You're going to like it. It has its own web address. I can tell it to you over here, but it's not going to resonate. I'm going to ask you, my email's on screen, Angie@producersxl.com. I'd like to send you the link. It's long and got dashes and hash marks and all that kind of stuff, so it's going to be too hard to describe verbally on the podcast. But this online calculator does not require a login, does not require you to be contracted, does not require a password or a two-step authentication. You literally go to this, save it as a favorite on your desktop, in your internet browser, pull it up. It's click, click, click. I mean, there's just a couple of clicks, and then all of a sudden it's going to show you and generate out an illustration for you that's very easy to read. Fantastic move. Makes it easy for you, especially if you're talking to somebody and all of a sudden you're in the Medicare space and you want to broach long-term care. Boom, quick online calculator, tick, 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 and you're there. I love that. I want to recap a little bit too for you, a little bit of the National Guardian Life or the NGL story. Remember, when they got into long-term care, it was back in 2016. They are a new player, if you will, only reaching their 10-year mark in the long-term care space. So they came in as a conservative Midwest mutual company that entered the LTC in 2016, right? They priced their product at a 0% lapse rate. So what that tells you, of course, they've not ever had any in-force rate actions on any of their blocks. And the primary reason is they priced it with a 0 lapse rate, which of course, that's not, if you go clear back to the origination of the long-term care space, that is not how they priced it. We looked at it as a much higher double-digit lapse rate. That didn't happen. People buy this with the intent that they're going to need it and use it. So no lapse rate, and they have no legacy business, right? They've not been in this space and have old legacy blocks of business that they're having to monitor and reprice and increase and things of that nature. So I like to refer to that as they don't have any junk in their trunk. So they're able to go forward, and their risk-based capital, their RBC percentage, is at 615% as of November of 2025. Strong, strong. It's easy to tell the story about NGL's long-term care. I do wholeheartedly believe that traditional long-term care still has a fit in the long-term care space. I will die on the sword that LTC insurance is not dead. It does not have to be a hybrid, a single premium, a chronic illness, a non-premium charging chronic illness. I don't believe it has to be that to be of value to consumers. Definitely has a fit. I just think a lot of the attention is given to financial planners and they know the wealth of their clients. There's definitely that story to be told, right? But for you P&C agents or you benefit brokers or people that are out there and you're getting the requests from your clients, hey, what do you know about long-term care? Don't overlook traditional. There's some strong stories to be told. And the last thing I actually want to leave with you is, and I love that they're telling the story this way. So health span versus lifespan. If you think about, right, long-term care insurance is based off of morbidity, not mortality, morbidity. So the lifespan is the number of years that we expect to live on average, right? We have mortality tables. That's how life insurance companies price their products. Health span is the average number of years we can live disease-free. So think about that, right? That's the whole point of long-term care. It's when you become chronically ill. If the average lifespan in the United States, and this comes from heart.org, www.heart.org, the average United States lifespan is 78.4. The average health span in the United States before dealing with kind of chronic illnesses, if you will. I'm not saying they're debilitating. I'm just saying you start right 63.9. Call it 64 years of age. I think all of us can relate that yes, at 64, most are taking some sort of a prescription. If they're lucky, it's just a cholesterol or a mild blood pressure, but there's a lot of heart conditions and there's a lot of diabetes. And those two definitely lead into morbidity concerns. I mean, if you've put anybody through underwriting lately, you know it's a concern. So the message is really clear, right? I mean, it's your health that buys your coverage. The long-term care insurance is nothing more than the funding mechanism to pay for your care when you need it. So the question really becomes, what's your plan when your health changes? Because everybody knows they're going to get to Medicare at some point, whether that's at 65 or younger because they're on early age disability. They stay on group health plan until they're older. they're delaying their Social Security, whatever the case is, but somewhere along the way, they're going to end up with a chronic illness and it happens sooner than later. And so what are you going to do? You need to know, per Paul, I believe it Paul Harvey back in my younger days, right? What's the rest of the story? Because it's not Medicare. Medicare is not paying for your long-term care. They do not pay for chronically ill individuals. I think page 55 in the Medicare New Handbook says that, 55 or 56. So I like those two things when you're out there building the story around why we need to have an extended care conversation. That's it. Because we get sick along the way before we die. How are we going to take care of that? And more importantly, how are you going to take care of those that you promised and that you love that you would take care of them? You can't do that when you can't take care of yourself. And if you have to use the dollars from your portfolio, whatever that is, I don't care if it's a savings account, if it's a mutual fund, if it's your IRA, if it's your tin can money, where's it coming from when you need care? So, super strong stories. Change the adage. What are we buying? Not nursing home insurance. We're buying stay-at-home insurance. Um, what happens when your health becomes compromised? Make the event manageable. And hey, a little bit of coverage does go a long way. So it should come in alongside and provide an income stream to pay for care when you need it. So with that, I want to thank you so much for joining me today, talking about the launch of National Guardian Life's newest traditional long-term care contract called Honest LTC. If you have questions, comments, want a quote, need the link for the online quoter, reach out to me, Angie at producersxl.com. Phone number is 800-541-6705. Always looking to make new friends. Again, thanks for joining me, and be sure to tune in next month. Who knows what my topic will be? Take care, everyone.